Let's bring in former Fed Chair Roger Ferguson. He's a former president and CEO of TIAA and now a distinguished fellow for international economics with the Council on Foreign Relations and a CNBC contributor. Roger, good to see you. The murmurings about 50 basis points. It went up a little. It's not at 50-50 yet, but it's getting close. We got a number on Friday that might play into this. I keep asking the same question, Roger. Is it possible, things go gradually until they happen all at once? I mean, could we get to a number that just, like this Friday, it's not going to be 500,000 new jobs, probably. Could it just disappoint in terms of, I don't know whether that's to call that a disappointment if it was soft, but could it be much less than could last month have been an outlier?
Look, so thanks. I think possibly last month was an outlier in terms of the 500,000 number. The weather has been relatively mild, et cetera. But I think the more important message, going through the ups and downs that we're seeing here, is that inflation is still very much a clear and present danger. The Fed has more work to do, and I think the market has come around to recognize that by pricing in perhaps a 50 basis point number. But more importantly, I think pricing in a higher terminal rate, and I think taking out of the market an expectation of a pivot towards cutting rates towards the end of this year. So I think the market is finally getting the message that the Fed has work to do, and the Fed itself, I think, fully recognizes that as well.
Is it still pandemic-related, the stubbornness of inflation? And there are those people, Roger, that point to some of the highs that we reach for inflation are in the rearview mirror now. I mean, everything is lower than it had been. It's not going as smoothly and as quickly as we hoped for. But is there really something different than what we're used to for the past 20 years in the labor market? It still seems like a post-pandemic phenomenon. Or is there really something different in terms of a wage price spiral?
Well, we're not yet seeing a real wage price spiral. What we are seeing is a very, very tight labor market. We're seeing a very uneven economy, with some areas clearly slowing because of rising rates. Think about the housing sector. Yet, I think there's still pent-up demand for services, and we see, particularly in some of the low and moderate jobs in services, that there are a number of openings. So this is a fairly unusual configuration for sure, Joe. But the baseline is imbalances in the labor market are clearly still feeding into inflationary pressures that, while coming down very gradually, are still very much above the Fed's 2% target. So the Fed clearly has more work to do, and the market needs to get its head around the fact that the Fed may be tightening even more than the market currently expects.
I mean, that seems like you can explain some of the service inflation and demand from the same thing. We've reopened. People didn't eat at restaurants for a long time. People didn't travel for a long time. People didn't go to hotels for a long time. They didn't employ enough people because the demand wasn't there or couldn't get employees. People wanted to stay at home. All these things seem like, I don't want to use the word transitory, but I just don't see the endemic, systemic causes of inflation that are there. And I'm still just hoping that we don't kill the patient, and we haven't, and that should be a good thing, that the labor market's held up in the face of rising rates. But we don't look at it as a good thing. We look at it as a stubborn thing that won't roll over.
Well, look, it is both things, right? Everyone wants to see jobs created. We want to see good jobs created. We want to see them created at a price level or wage level that's consistent with the Fed's 2% inflation target. And that's a bit of the rub, right? When you do surveys, I've done surveys of CEOs, they're still expecting to increase wages 3, maybe 4%, not quite the outlying numbers that we saw before. And so, I think the Fed is attempting to hold on to as much of this job growth and forward momentum as they can, consistent with bringing inflation back down under control. What's been interesting to me is how much forward momentum is still in the economy, given how much tightening the Fed has done. And it shows that famous long and variable lags are very much at work here for the reasons that you point out. The reopening of the economy was very service-oriented, and that really hasn't faded completely just yet.